Hello, and welcome to Dragon Financial. Today, we will discuss the basics of put options and how they work. First, we'll review what we just learned about call options in the previous class. Next, we'll look at buying a put option. And at the end of the video, we'll go over selling a put option. Options can be difficult to learn. So, if you have not seen the companion video, Intro to Call Options, go ahead and click here to get a basic understanding of call options before starting this class. Let's review what we learned in the last class. We learned that with buying call options, you want to be bullish on a stock because it gives you the right to buy 100 shares at your strike price. You have a max risk limited to the premium you pay for the option. On the profit loss chart, we can see we have an unlimited profit potential to the upside. With buying puts, you want the exact opposite of buying a call because it gives you the right to sell 100 shares at your strike price. So you want to be bearish. Your max risk is still limited to the premium you pay for the option, and with the profit loss chart, we can see that we have an unlimited profit potential to the downside. This is Brad. Brad wants to buy his first put option. But what does he need to know? In this series, we'll walk you through the basics step by step using a fictional stock called XYZ, priced at $100. With easy to understand examples, you'll learn the fundamental principles of put options. And later in the series, we'll delve into real life scenarios. So don't miss out on future episodes. Hit that like and subscribe button to stay updated on our next video. Brad has just learned the company XYZ will be hit with a class action lawsuit. Brad believes the stock will go down considerably once this news is released. He wants to short 100 shares of the company to cash in. Brad could short 100 shares of the company at $100 a share, but this is difficult, and Brad doesn't understand how it works. But Brad has also learned about a put option. He can buy a put option for 3 months at $5 a share for a total of $500. Brad decides to buy the put option, which will give him control over selling 100 shares of the company for the next 3 months. So let's review what Brad chose. He chose the stock XYZ, which is currently $100. XYZ is the stock symbol. It is also known as the underlying, and it is what the option contract gets its value from, hence derivative. If this doesn't make any sense, you probably need a review, so go ahead and click the link to review the basics of the stock market here. Brad thinks XYZ will go down a lot, so we can see Brad is bearish on the stock. It costs $5 a share, so his total risk for the put option is $500. This is the max amount he can lose. Next, Brad calculates his break-even at expiration, which is the strike price minus what he paid, $5 per share. The price you pay is called the premium, so his break-even is $95. If XYZ is under $95, he will start making money. His profit potential is mathematically unlimited to zero because the stock price can go down to zero. And for Brad, anything below $95 per share in the next 3 months is pure profit. Let's review a couple of options terms. Strike price, the price the put owners can sell the stock. Expiration, the date on which the put option expires. Premium, the price which the buyer pays to the seller. Max risk, the most money you can lose. Break even, the price at expiration that you will lose $0. Now we will take a look at the option payoff diagram at expiration. If the stock is more than $100 at expiration, you'll be in the red zone with your max loss of $5 per share or $500. If the stock is between the strike price of $100 and the break even of $95, you will be in the yellow zone and lose less than your max loss. Finally, if the stock is less than $95 at expiration, you'll be in the green zone and make money. Your profit potential is mathematically unlimited. Let's go back to Brad and look at 3 scenarios with the stock. Scenario 1, the lawsuit was immediately dismissed and the stock never dropped. Because the stock is still at the $100 strike price he bought, Brad lets his option expire for his max loss of $500, or what he paid. Scenario 2, the lawsuit was not as bad as Brad feared, and the price of the stock dropped a little, So the stock price went from $100 to $97 a share. So Brad sells his option for $3 per share or $300. However, remember, Brad paid $5 per share or $500 for the option, so Brad will still lose $2 per share or $200. Scenario 3. Brad was right. An XYZ lawsuit was huge, and the stock price went down to $70 per share. So Brad sells his option for $30 a share or $300. Remember, Brad paid $5 per share or $500 for the option, so Brad's total profit is $2,500. Now we are going to look at selling a put option. Many things are similar, but there are some key differences. Let's review what we learned in the last class about selling calls. We learned that with selling call options, you want to be neutral to slightly bearish on a stock because it gives you the right to sell 100 shares at your strike price. You have an unlimited max risk, but you will receive a premium for selling the option. On the profit loss chart, we can see we get paid a premium, but have an unlimited loss potential if the stock continues to go up. With selling puts, you want the exact opposite of selling a call because it gives you the right to buy 100 shares at your strike price. So you want to be neutral to slightly bullish. You have an unlimited max risk, but you will receive a premium for selling the option. On the profit loss chart, we can see we get paid a premium, but have an unlimited loss potential to 0 if the stock continues to go down. Let's go back to Brad. Brad made a lot of money on his 3-month put option as XYZ dropped during the lawsuit. But during the earnings call, Brad learned that the ruling for the lawsuit won't be released for another year. Brad remembers all the fear the news about the lawsuit caused, and the stock went down to $70 per share. But without the lawsuit verdict, he doesn't think it will go below this price. So Brad is neutral or slightly bullish on the company. Brad decides to sell a put option on XYZ stock at $70 strike price for the next 3 months for $5 a share. So let's review what Brad chose. We have the same stock, XYZ, but now it is $70 per share. He is selling a put option contract, so we'll have an obligation to buy 100 shares of the stock if it is below $70 at expiration. His expiration for this contract will be 3 months. His view on the stock is neutral to slightly bullish. Before we calculate our max risk and break even, we should review what selling a put option means. Remember, buying a put option gives you the right to sell 100 shares at your strike price. Selling a put option gives you an obligation or contract to buy the 100 shares at the strike price. So when we calculate the max loss, it is mathematically unlimited to 0 because the stock XYZ can go down any amount, and Brad has to buy the shares from the buyer at $70. Unlimited loss? You have to be kidding me. Why would I ever do that? I know this sounds scary, but stick with this program. I can show you how to eliminate these losses, or even in some cases, eliminate them entirely. Now, let's calculate our break even. Brad was paid $5 per share premium to sell the call option. Yes, you heard that right. He was paid money to enter the trade. How cool is that? So, Brad has to buy the shares at $70 from the buyer, but he got paid a $5 premium per share. So his break even is $70 minus $5, which equals $65 per share. Okay, let's move over to the option payoff diagram. If the stock stays above $70 at expiration, Brad will be in the green zone and keep his max profit of $5 per share that he got paid up front. So, if the stock goes up or even stays flat, Brad makes his max profit. If the stock is above his break even of $65 per share and below his strike price of $70 per share, Brad will be in the yellow zone and he will make a small gain on the trade. This means even if the stock goes down a little, Brad makes money. Finally, if the stock is less than its break even of $65 per share, Brad's loss is mathematically unlimited depending on how low the stock goes. As you can see, if the stock goes up, stays the same, or even goes down a little bit, Brad makes money. However, if the stock goes down a lot, Brad can lose a mathematically unlimited amount of money to 0. So this trade can be very risky. It is important to understand options before entering an unlimited risk trade. Let's go back to Brad and look at 3 scenarios with the stock. Scenario 1, the company had no new news about the trial, and the stock started to drift upward to $85 per share at expiration. Because the stock is over Brad's strike price of $70 per share at expiration, Brad will be in the green zone and keep his premium of $5 per share for his max profit. Scenario 2, the company announced that the verdict for the trial will be released in 6 months, which is well after Brad's expiration date. But people started to worry, so the stock drifted down to $68 per share at expiration. Because the stock is below Brad's strike price of $70 per share, but still above his break even of $65 per share, it will be in the yellow zone. Brad will buy back his option for $3 per share or $300 to finish the trade. But remember, Brad was paid his premium at the beginning of the trade of $5 per share or $500, so Brad will make a small profit of $2 per share or $200 on this trade. Scenario 3. The judge ruled on the case early and against XYZ. This caused XYZ stock to tank to $40 per share, which put it in the red zone for Brad. He closed out the trade by paying the difference between his strike price and the current stock price. His strike price of $70 per share minus the current price of $40 per share for a loss of $30 per share or $3,000. But remember, Brad was paid $5 per share or a $500 premium when he sold the call, so his total loss will only be $2,500. Finally, let's wrap up by reviewing what we learned. When buying a put option, you will pay the premium and want to be bearish on the stock. You can only make money if the stock goes down a lot, and will lose money if it goes down a little and reach your max loss if it stays above your strike price. When you sell a put option, you'll get paid the premium and want to be neutral or bullish on the stock. You will make money if the stock goes up, stays neutral, or even if it goes down a little. But will have a mathematically unlimited loss to zero if the stock price goes down a lot. There you have it, an introduction to buying and selling put options. I'm a teacher at heart, and I can't tell you how excited I am to introduce you to options. My name is Brad, and I have been investing in the stock market for over 10 years. I'm dedicated to sharing my knowledge and helping everyone become better stock traders. If you find this information useful, please like and subscribe so we can get it out to those who need it. If you are new to investing, check out my Basics of the Stock Market playlist here. Thanks for watching, and I'll see you in the following video as we learn how to read an options chart.